Welcome to the Deep Dive. We're here to cut through the noise of corporate earnings calls and give you the insights that matter.
That's right. Today we're tackling ExxonMobil's Q3 2025 results. It's a fascinating one because, well, operationally they look strong, but the market reaction was kind of flat.
Yeah, that's the real head scratcher we want to unpack.
Well,
why the disconnect? But first, let's hit those headline numbers. Adjusted EPS, the one everyone watches, came in at $1.88.
which beat the consensus of $1.82. So a solid beat on that front. Operationally, they executed.
But then you look at GAAP EPS and it's $1.76. That's down from $1.92 last year. Softer commodity prices biting there, I guess.
Exactly. And maybe, just maybe, the bigger drag was revenue. $85.3 billion. It missed the $86.8 billion target slightly.
Just a slight miss, but maybe enough to spook the market?
Could be, or maybe it was just the overall commodity picture. Brent crude was down, 13% year over year in Q3. That creates headwinds, even with strong execution.
Okay, and cash flow. That seemed like a mixed bag.
Definitely. Cash flow from operations, CFO, that looked pretty robust, $14.8 billion. Solid number.
But free cash flow, FCF, that took a big step down, didn't it?
Yeah.
$6.3 billion, down from $11.3 billion.
Right. And that FCF number tells a story, doesn't it? It shows you just how much capital they're pouring back into the business right now, all those big projects.
So high investment, which lowers FCF in the short term, makes sense.
It does, but the market, maybe focused on that revenue miss, the lower Brent price, and just kind of shrugged. Shares basically went nowhere.
Okay, so to figure out why the market might be missing something, we need to dig into those operational wins. Management sounded pretty bullish there. Production numbers first.
Yeah, impressive stuff. Total production hit about 4.8 million barrels of oil equivalent per day. A huge number.
Driven by.
The usual suspects really cranking. The Permian Basin and Guyana. The Permian actually set a new record, getting close to 1.7 million barrels oil equivalent per day.
And it's not just drilling more, right? There was some interesting tech talk there, something about proppant.
Oh yeah, the proprietary lightweight proppant. This is potentially a game changer for them. It's made from low-cost refinery coke, apparently.
Okay, remind us, proppant is the stuff they pump down to keep the fracs open.
Exactly. Sand, ceramics, that kind of thing. Better proppant, better flow. Theirs, because it's lightweight, supposedly gets deeper into the fractures.
And the result?
They're claiming it can boost well recoveries by up to 20%. I mean, think about that. 20% more oil from the same well. That's a massive efficiency gain.
Wow. 20% is huge. Are they actually using it much yet?
They are scaling it fast. Said about a quarter of their wells drilled this year used it, and they're targeting almost half of their new wells by the end of 2026.
So that tech edge is a real differentiator. Plus, didn't they just add more land there too?
They did. Picked up over 80,000 net acres in the Midland Basin from Sayakin Petroleum. So more drilling inventory plus better tech. That's the Permian story.
Okay, shifting offshore. Guyana. Still going strong.
Blistering pace is the phrase that comes to mind. Production topped 700,000 barrels of oil equivalent per day. And the execution, Yellowtail startup, 4 months ahead of schedule. And that's despite the FPSO, the floating production unit, being 70% heavier than the previous ones. That's just phenomenal project management.
4 months early on something that complex is seriously impressive.
It really is. And they're not stopping. They just announced the 7th development, Hammerhead, kicking off in 2029.
It ties back to what the CEO keeps saying, right? About needing more barrels just to stay flat.
Exactly. He hammered that point home. The industry has to bring on more barrels just to stand still, especially with unconventionals depleting so fast. It explains why they're focused on adding capacity when some competitors are kind of shifting to harvest mode. It's a real strategic fork in the road.
And they seem to be delivering on these big projects overall.
Yeah, the scorecard looked good. 8 out of 10 major project startups for 2025 are already done year to date.
And the last two.
The Proxima expansion and Golden Pass LNG, both apparently on track for year-end. And get this, those 10 projects alone are expected to add over $3 billion to earnings next year.
Okay, $3 billion. That's serious impact. That kind of scale requires, well, a lot of capital, but also maybe something more.
Right. Which brings us perfectly to the other side of the story, the strategic pivot, the whole beyond the barrel narrative.
Yeah, well, let's explore that. They seem serious about becoming more than just an oil company. Advanced materials, tech, graphite was a big focus this quarter.
Huge focus. They bought those key assets from Superior Graphite. And they're pushing hard on their own battery anode graphite. The claims they're making are, well, pretty bold.
Bold how? What are they claiming?
Okay, get ready for this. Their proprietary anode material, based on their tests, could lead to batteries that charge 30% faster,
Okay.
offer 30% more effective range.
Right.
And this is the kicker, potentially last up to 4 times longer.
Whoa. Hold on. 4 times longer battery life?
Yeah.
From an oil company's tech. That sounds ambitious.
It does, doesn't it? And you have to be skeptical about battery breakthroughs. They often disappoint. But here's why it might be credible, or at least why they think it is. It's the manufacturing process.
How they make the graphite.
Exactly. Their new graphitization process is supposedly 50% more energy efficient and significantly lower cost than the old methods, some of which apparently date back to the 1800s.
So they're using modern chemical engineering to leapfrog ancient tech.
That seems to be the argument. A better, cheaper, greener way to make this critical battery material, that creates a potential cost advantage, a real moat.
And the market size for this?
Management pegged the total addressable market, the TAM, for just this battery anode stuff at potentially $40 billion.
Okay, $40 billion. That definitely justifies the effort, if they can pull it off.
If they can pull it off. It's a big if, but the potential is massive. And it wasn't just batteries. They talked about Proxima systems, too. Their other advanced carbon materials.
Right. What are the examples there?
They highlighted using it in rebar for construction, claimed a 40% improvement in installation efficiency, and also a new one-coat paint for marine cargo tanks that replaces the old 3-coat process.
Cutting coating time basically in half. Niche maybe, but high margin.
You'd assume so. Differentiated products, and underpinning all of this finding oil fast or developing new materials is computing power.
Ah, yes, the supercomputer mentioned, Discovery 6.
That's the one. Now ranked the 17th most powerful computer in the world.
Why does an oil company need that much computing power? Seismic data.
Primarily, yeah. Processing those huge seismic data sets to figure out where the oil and gas is, it used to take months to run the really complex models.
And now?
With Discovery 6, weeks. They explicitly said it's already unlocked over $1 billion in potential value just by allowing faster, more accurate drilling decisions in places like Guyana.
So the tech advantage isn't just the proppant, it's the digital horsepower behind the exploration too.
Exactly. It all feeds into their argument about having unmatched scale and technical capability.
Okay, but capability costs money. Let's talk capital discipline. That huge investment we mentioned. Is it getting out of hand?
Well, actually, the update there was positive for investors worried about spending. CapEx for the year is now trending below the low end of their $27 to $29 billion range.
Below the low end. Why? Did projects get cheaper?
Not exactly. Management was pretty clear. They're deliberately pacing the spending on some of the low-carbon solutions.
Meaning slowing down.
Essentially, yeah, because they feel those markets, things like carbon capture, just aren't developing as fast as maybe they initially hoped. So instead of throwing money at it before the demand is really there, they're being disciplined, holding back a bit.
So not abandoning the ambition, just matching the investment to the market reality. That sounds prudent, actually.
That's how they framed it. Disciplined capital allocation. And of course, they keep highlighting the cost savings.
The structural cost reductions, still a big focus.
Oh, yeah. They hit that $14 billion mark in cumulative savings since 2019. And they made a point of saying they think their ability to drive costs out is basically unmatched by peers.
Okay, cost control, project execution. What about shareholder returns? That's always key.
Still a major priority. They raised the dividend again, up 4% to $1.03 per share for the fourth quarter.
4%. I saw some analysts call that a bit pedestrian.
Yeah, that word came up, compared to maybe some peers doing bigger, splashier dividend hikes or specials.
How did the company respond?
The CFO pushed back pretty firmly, said their focus is on a durable dividend, one they can sustain and grow consistently through the cycles. She pointed to the track record, 43 straight years of increases.
43 years, okay. That puts them in pretty rare company in the S&P 500.
Very rare. The message is, we value consistency and reliability over short-term pops. They also mentioned share buybacks were strong, $5.1 billion in Q3, keeping them on track for that $20 billion annual target.
And they also mentioned something new for retail shareholders.
Oh, right. The new program allows retail folks to sort of automatically opt in to vote their shares along with management recommendations, trying to boost participation from that huge retail base they have.
Interesting. Okay, so before we get to our final segment, let's just quickly recap the macro backdrop again. Q3 saw Brent down 13% year over year, but U.S. natural gas was actually up 38%.
Right, a really mixed commodity tape. which probably explains a lot of that flat stock reaction. Strong operations met a confusing, somewhat weak oil price environment.
And the next big thing to watch for is?
December 9th, their corporate plan update. That's when we'll get more color on 2026 plans and maybe some longer-term targets.
Got it. Okay, this all sets us up nicely for...
The thought experiment.
Exactly. Time for the segment we call, This is Not Financial Advice. Just a reminder, these are purely analytical ideas based on the call, not recommendations.
All right. So given everything we've discussed, strong ops, flat stock, this huge potential in graphite tech that the market seems to be ignoring, here's an outrageous but maybe plausible idea.
Lay it on us.
A long-term call option, like 3 years out, deep in the money. And the entire thesis is pinned on the synthetic graphite business getting properly valued.
So you're ignoring the oil and gas, essentially.
Yeah.
Betting purely on the advanced materials side.
Pretty much. Look, the market currently values ExxonMobil as an integrated oil company. Slow growth, cyclical, tied to commodity prices. But if, and it's an if, but if those battery anode claims prove out at scale...
The 30% range increase, the 4 times longer life.
Yeah. If that happens, the market has to re-rate that part of the business. It's not an oil segment anymore. It's a high-growth, advanced materials, maybe even a tech segment, with a $40 billion TAM.
So the option acts like a leveraged bet on that specific technological disruption, isolating it from the day-to-day swings in crude oil prices.
Exactly. You're protected from the commodity volatility, mostly, and you capture the massive potential upside if they actually revolutionize battery materials using their engineering and process advantages. It's a bet on the transformation.
A fascinating way to potentially play that disconnect between operations and valuation. Okay, let's wrap this up. What are the core takeaways from this Q3 deep dive?
I'd say 3 things stand out. 1, operational execution is genuinely strong, especially in the Permian with that proppant tech and Guyana's project delivery. They seem to be widening their lead there.
Okay, execution is number 1. Number 2.
Capital discipline looks real. Trending below CapEx guidance by pacing low-carbon spend shows they're not just throwing money around. Plus, those ongoing huge structural cost cuts.
Discipline is 2. And 3.
The strategic stuff, beyond the barrel, the synthetic graphite, Proxima materials, the Discovery 6 supercomputer, it shows massive potential, even if the market isn't pricing it in yet.
Right. Potential that the market is currently ignoring because it's focused on today's oil price.
Seems that way.
So the final thought for you, our listener, to chew on. Management keeps talking about their unmatched scale and technical capabilities, boosted by things like AI with Discovery 6. They claim these cost reductions are unmatched. If that's true, how much value is still locked up inside this company purely based on its technical prowess that the market is completely overlooking right now?
That gap between what they say they can do technologically and how the market values them, that's the multi-billion-dollar question for the next year or 2.
A perfect place to leave it. Thanks for joining us on the deep dive. Remember, everything discussed here, especially the trade idea, is for informational purposes only and definitely not financial advice. Keep digging, keep learning, and we'll talk to you next time.